into one of the last shows of the first half of 2024. Welcome to Freightonomics. Zach Strickland, Director of Freight Market Intelligence. Tony Mulvey, Head of Research.
Not quite.
No?
Like senior analyst.
Senior analyst.
So,
and here to combine that freight market into the economic atmosphere, supply chain environment. And we've had a pretty, I don't know that I would call it interesting first half in the context of the last 5 years, because it's been actually pretty mild.
Yeah.
But I think there's been enough stuff going on that I think piques our interest coming into the second half, where we need to, there's things to watch now. Whereas this time last year, I don't know that we had a lot.
it's almost like we can see a light at the tunnel. We don't know how fast we're getting to that light, right? Coming out on the other side versus going into this abyss of darkness that we were last year. And it's like
Making it
any light that was at the end of the tunnel was so small that it was like, okay, where are we in this tunnel? Like,
Well, it depends on your perspective.
We had just come barreling into a tunnel that we didn't know how long it was going to be.
Well, it depends on your perspective, too. From a shipping standpoint, transportation procurement standpoint, things have been cake on domestic trucking. Now, ocean and air, the international scene is probably where the majority of the interest in activity lies right now. But there are some signs that that's starting to trickle in and, to the domestic market. There is, like you say, from a service provider standpoint, a light at the end of the tunnel starting to peak up. How strong or how bright of a light that is, that has yet to be seen. But we also had a tropical system developing in the Gulf of Mexico. I don't think there's anything super big there, but something to talk about. Just a fun little teaser for next week. You're going to be in Ireland.
I will be in Ireland.
And Kaylee Nix will be joining me to talk some dynamics and how weather influences the freight market, which
I think this one actually caught me by surprise. More so that it was just, it felt like it got here really fast. Like
what happens?
It can, well, I mean, sometimes like you hear, hey, like a tropical system's like forming off the coast of Africa and you track it the whole way. Like, no, this was like here and then landfall within like a couple of days.
Yeah.
I mean, or at least that's how it felt. Like it was like now granted, I haven't been as in tune with like news and stuff like that, but it felt like it was just like, hey, there's a tropical storm about to hit Houston.
Well, we've actually had stronger weather events already occur that weren't tropically related. So I think those get the headlines, but something to break down for sure next week. But first up, Tony, let's
set the stage and where the market is, Zach. So I'll count you on here for your market in 3, 2, 1.
All right, let's start things off with the OTRI. Now, I've talked about the tender rejection index, which is the percentage of loads being rejected by carrier from their contracted shipper accounts. A rejection rate below 5%, extremely loose, easy to get capacity. Anything above about 7, 8, 9% tends to be tight. We have been below 5% for a long time. However, that has changed. We are now above 5% for the last couple of days. And as I mentioned before, it looks like 2019 may be the blueprint to follow for what to expect for the rest of the year. Tender rejection rates kind of jumping up. July 4th is the summer peak of tight capacity / demand. We tend to see that sense of urgency, end of a quarter, holiday week. Holidays on a Thursday this year, too. So definitely a period to watch for less capacity, but it looks like maybe things will smooth out after the holiday. Time will tell. Let's go to the next chart here. Look at spot rates, NTIL, National Truckload Index, excluding the total cost of estimated fuel. Spot rates responding almost the exact same way that rejection rates are, jumping up there, plateauing earlier than they did in 2019. We see a big little spike, if I can say oxymoron, and there towards, as we're getting closer to the end of the month, again, 2019, maybe not necessarily the exact blueprint because of inflation, but spot rates remain elevated in this plateauing standpoint. A lot of that coming from Southern California, Atlanta, Savannah, southern tier of the country, not so much in the Northeast or Midwest. Let's go to the next chart. Talk about demand side dynamics in the freight market. Tender volume index here, which counts the total number of tenders, requests from shipper to carrier. Index looks very, very strong compared to last year. At this point, we are plateauing heading into July 4th. But if we look at historical patterns, it looks like this may persist, but also kind of fall off as we exit the month of July into August.
Yeah, I mean, I think
that's a theory, by the way. That's not necessarily a given. That's kind of like if you look at historical trends, which you do and you don't.
Yeah, volume's maybe harder to paint the trend on just because like ordering patterns end up changing to some degree. Timing of ordering changes, things like that. I think the capacity one, when you look at rejection rates, I think that one's probably the closer blueprint in terms of trend because it's...
And that was the most useful. Like demand is not, it's from a transportation service provider standpoint, the use case just isn't very good there right now outside of some market share. Like which markets are growing relative to the others? Like where is that demand really getting focused? Are we seeing like traditional network changing shifts in demand underlying that? And we have seen some of that.
Yeah.
I think this Southern California situation is definitely something that any transportation, I don't care if you're in the region or not, you should be watching Southern California.
Yeah, because I mean, it tends to lead the entire country. And you didn't get to this chart, but let's go ahead and pull it up. Is the inbound ocean TEU volume index. I mean, that thing is fairly strong. I mean, look at that. Really, from what, our first week in May, it's been trending higher since. And you look at the difference between this year in the white line and last year in the blue line, and like you don't see any slowdown. I mean, really no lull post Lunar New Year this year.
It's a very consistent pattern of demand, and we're actually increasing heading into what most would consider the peak season, July, August, for shipping. And this is the bookings index. It's counting the total number of TEUs, 14-day moving average, for everything coming from around the world into the United States. And, you know, traditionally you see this really pick up at the end of July into August. COVID year there, you've got a little noise in 2022. But we should be not necessarily at a low point, but
yeah, I mean, to see it climbing, I think is the take. Like we should have been, what we saw was the low kind of where you would have traditionally seen it kind of in that early May timeframe.
Yeah.
You saw it, but it was a lot higher than it had been in the past. Like you didn't really see this subsequent decline. And I think the key there is, hey, this is freight that is coming into these port markets and across the country. And like, that's my thinking is like, if you're not paying attention to what's going on in the port markets now, like there's more demand coming in these markets at some point, right? Because
think about it, all the markets I just named, Los Angeles, Savannah. I mean, Atlanta's not a port market. Houston.
But it operates very similar because those goods flow from, they typically flow Savannah to Atlanta and then out.
There's an inland port right there too.
So you're seeing movements that would be, hey, demand from imports have been up. We've seen it. Now you're seeing demand at these, call it port markets. It's flowing from imports, clearing the ports.
Right.
Now it's flowing into the truckload market. It's a matter of timing, and that can vary.
And I think this is a good segue as I want to talk econ here in just a second, but you know, it's not like we're seeing this robust growth in economy.
No.
Anecdotally speaking, and of course, some of the data also supports this concept that service is not great on bringing goods into the country. We've got a lot of supply chain uncertainty, and anything that before it hits our borders. We've seen the tender rejection rates for that increase. We've also heard that capacity is not as available coming across the Pacific Ocean because of all the geopolitical stuff.
Yeah, you've had a combination of a few things.
There's some storylines there, but regardless, shippers are having trouble getting consistent service on bringing their goods to the country, and that may be helping really boost demand in the country.
Yeah, because if you're uncertain, you're going to. It's what happened during COVID, right? This massive pull forward because the competition heats up so much that you're willing to pay basically anything to get your container onto a ship. But then you're also acting a lot earlier because you know, hey, if I don't know that this is going to be here in 6 weeks, that's fairly consistent, and it may take 9 weeks, well, I have to order things 3 weeks earlier than what I was. And that's just like this, it just spirals out of control, especially right now where you look at the ocean carriers, they've been really disciplined in how they deploy capacity across the globe.
What a political way to say that.
But I think what's interesting is, so Zim, Integrated Shipping, the ninth largest ocean carrier, heavily exposed to spot price. They highlighted in their first quarter earnings call at the end of May that there's supply side risk to ocean carriers, because what did ocean carriers do during the pandemic? They made a boatload of money. They're not very good allocators of capital. What did they do? They bought more boats. It takes a lot of time to build these boats that are, you know, hundreds of millions of dollars, and they're going to have to take delivery of said boats. Now, the question is, there's not really a secondary market like the truckload market, right? Like, they're not going to go and sell the old ones to someone else. Like, they will to some degree, but are they going to, and they bought bigger boats too. It wasn't just that they bought new boats, it's they bought bigger boats. So it's like they have to pull more capacity off the ocean that's already moving to bring these in. So you run there's some level of risk really from the ocean perspective, from the supply side. But I think right now you look at the levels of demand and it's just not.
Well, yes, I want to talk that through once we get to our news, but let's talk Econ for a second, because we're talking about demand being stronger than expected.
Yeah.
We just had a retail sales number come out
that was softer than expected.
Not expected. So what's the read here?
Yeah, so retail sales increased 0.1% month over month in May. Expectations were increases of 0.2%, so underwhelming overall. I think what was the good news from a month over month perspective is if you look at the CPI, it's flat.
Right.
Retail sales grew by 0.1%. You see some growth overall. Then you look at the annual number. You saw 2.3% increase year over year in retail sales. Well, inflation's above 3%.
Right.
It's kind of a signal that, hey, real retail sales or real goods, the value of real goods moving is less than what it was last year. I think my read on it is when you start drilling into some of the numbers. I mean, you see, we talked about it kind of last week, looking at Bank of America's data, it kind of highlighted it. Slowdowns in building materials, furniture, kind of the more durable goods, larger ticket items. To me, it doesn't seem like that's a big surprise. It wasn't a big surprise to see those down. I think from a consumer perspective, you're seeing them be more selective in goods that they're buying, especially larger ticket items. They're not, the question is, are they doing it because those are goods that they would have financed in the past, that now with interest rates, especially on loans like that, you're talking, if you put it on a credit card, 20% interest. I don't even know what like a, say a buy now, pay later or something like that loan that isn't reported to the credit bureau, like what does that look like? And then, I mean, so overall, the question is, are they delaying these purchases in hopes that interest rates fall? Or are they just saying, hey, we can't justify spending, you know, thousands of dollars on goods? So I think that's my big takeaway. It's like, all right, you're seeing a slowdown in big ticket purchases. To when and does that flow through? I think the other side that you don't see in retail sales is the services side to some degree. Like it doesn't touch on entertainment and airline and lodging and things like that in the Bank of America credit card report showed slowdowns year over year. You don't actually get the read through in the retail sales. So I think that's something to pay attention to, because a lot of people are talking about consumer demand and like travel demand being relatively strong. And it's like you look at credit card data and it's like maybe it's not as strong as everybody.
Inflation's really making it hard to take a good read. And also the fact that people are trading down to, you know.
Yeah, I mean, grocery spending's flat.
Yeah.
Or flat to up slightly.
Yeah. But it's hard to
But
derive like
you
a
can't.
number of goods from the
Yeah,
dollar
it's all
figures at this
dollar.
point.
Yeah, I mean, I think that's the biggest
Yeah.
the biggest challenge in equating it to call it freight demand or anything like that is it's all in dollars, and if the value of the good goes up, like, or the amount of the dollars that are sold goes up, like you're going to see an increase in retail sales. If inflation rips that all out,
Yeah.
right? Like the actual good, the price, I mean, like I think that's the biggest issue is like there's no price weighting of these things. Like
Yeah.
you're not adjusting anything for price.
Right.
So it kind of
we
makes
see
it
the
skewed.
OTVI and IOTI both outperforming.
Yeah. If it's lower value goods coming in,
Then
like you
okay.
can see retail sales plummet,
yeah.
and you have a good that was, you were buying the $10 one, now you're buying the $5 one. Well, you cut the sale in half, but the actual good is still 1-to-1.
Yeah.
And I think that's the part that it's really hard to get any strong read. I think it's more telling when things are extremely robust or they're very, very weak, right?
Yeah.
Like that you can tell. It's this kind of in between where we are right now, where it's like
Dollar figures drive me nuts as aggregate indicators.
well, I mean,
and
that's why GDP isn't the best read for overall freight demand, because it's all dollar figures, and it adds a level of complexity to trying to figure out where the market is.
So I think the economic read for the rest of the year is relatively flat until.
Yeah, I mean, I'm probably more bearish on the overall economy than most people are.
But it's not like a sharp downturn.
Yeah, no, it's
like
just more of a, I don't
slowing.
see robust economic growth necessarily, because like there's signs that it's like a retail sales number that comes in at 0.1, like that doesn't give me good reason to believe that we're going to see 5% growth or 3% growth. Like if you take 0.1% growth over the course of the year, it's not real robust when you add it all up. Like 1%, if you grow at a month over month basis, just over 1% for the annualized, or like that's, I wouldn't call that robust growth. And I think that's the other side is you've seen GDP growth slow for multiple quarters in a row now, and then revised lower for the first quarter.
Everything getting revised lower.
and I think that seems to be the theme. Like everything comes out strong and then it revised lower. I think that's where
that feels
I think
bad.
that's some of the bearishness or less optimistic outlook that I have, is that you're not getting things revised higher, which is what you would want.
Consistently.
Yeah.
So I want to switch to the news of Nomics, because this is how I want to spend the rest of the show. Article written by Eric Coolidge. U.S. logistics inflation remains high despite 11% drop in costs. And the takeaway, this is a CSCMP, generated report here that he's reporting on, I should say. The report compiled by Kearney said there is an increasing recognition among logistics executives that volatility is the normal condition for supply chains, which makes it critical to have a robust, flexible transportation and warehousing network. So this report, and we can go ahead and pull up this chart here, logistics costs as a percentage of GDP. So the cost of moving goods and storing goods is warehousing and transportation and everything that entails, is still relatively high, 8.7% in 2023. And that was a down year.
Yeah.
So we had the peak of percentage of, the economy at 9.1% in 2022 or 2021, I should say. And we've come down, but we're still well above where we were. So the cost of moving goods and stuff is actually inflated, even with the domestic truckload costs coming down. I mean, we look at the contract rates, they're still a lot higher than they were prior to COVID.
Yeah, it's
even though they're not covering the cost of operation in a lot of cases.
Yeah, I mean, I think that was more you kind of stole what I was going to say, is like they're higher because they have to be higher, basically.
Right.
It's not,
but it looks like they're eroding into the cost of everything else.
Yeah.
Like even though the costs have come down, they're not moving back down to that 7% range that we were seeing. I mean, we said that, the 2016 environment was relatively soft. 2019 very soft. Those are 7.4 and 7.5% cost of, transportation logistics. We're at 8.7% and arguably one of the softest markets in history.
Yeah, I mean, you had, if you look
from
at
a service provider perspective.
Yeah, I mean, if you look at this, you had logistics costs up 22.4% in 2021 and over 20 or almost 20 in 2022. I mean, if your baseline pre-pandemic was 1.5 trillion, I mean, we were still at 2.4 trillion last year, right?
Yeah. So from a procurement perspective, you have to now allocate and budget for a higher cost.
And I think that's the challenge is CFOs are turning to transportation departments and supply chains.
They're looking at 7.4% and saying, get me that.
Yeah, not 8% or 9%, right? And I think that's the challenge is like, you almost have to, it's really hard to push back against that because they're looking at 10 years of data prior or something like, hey, we need to be in this range. And in reality, this is the new, like, this is normal now because like,
we've seen
it's
rates
just more everything becomes more volatile, much more quick because available information is much more readily available. And I think that everybody talks about information reducing volatility, and I don't think that's the case. I think it makes it much more, the market much more,
depending on who's reading it and how they're interpreting.
Yeah, I think it makes it much more dynamic, the market. And because I say this, if you look at the stock market, the volatility in the stock market has arguably increased, but information is available now in a matter of milliseconds versus, the next day.
I think that's because people are naturally overreactive.
Yeah.
And I don't think that's the information's fault.
Yeah, no, I think it's people are making reads on information and how they're making those reads or what they're reading out of it changes.
And I think this is more of like I've talked about in the past. I think we have become a lot more nearsighted and near-term goal-oriented than we have in the past.
Yeah, I mean,
that's what creates a lot of this volatility.
Well, and
the information enables that.
That CFO, if you think about it, they're held to call it a quarterly budget, right? They're looking at 90 days time frame versus
that's what
5
their
years.
Investors are holding them accountable.
Yeah, exactly. So I think that's why you see them try to give
me that money,
aggressive, and why it doesn't necessarily make sense.
So I want to quickly go through some of the bigger takeaways from this article because we literally cover the entirety of the supply chain here. The authors projected a tightening of capacity and potential upturn in rates by the second half of this year, talking about the truckload side, because they say it's already happening in air and ocean freight.
Yep.
The air and ocean freight, I think one of the reasons why this percentage is higher is because COVID has kind of dislodged supply chains and they're much less efficient than they were because guess what? They're changing how they operate.
Yeah.
The procurement of goods has changed significantly. Another part of this, inventory levels are maintained a lot tighter. They talk about warehousing costs being a component of this. Inventory levels, of course, have been, moderating over the last year. It looks like we're in much more of a stable inventory level environment. Warehousing capacity is not necessarily as strong. If you look at the LMI here, you see capacity represented there alongside inventory levels, capacity being in white, inventory levels in purple. So they have an inverse relationship. The higher the inventory level, the lower level of capacity. So the read here is that we're back into a spot that inventory levels a little bit low, capacity is available, but warehousing prices are still expanding at some level. The next component of this, the rail. Briefly, rail traffic grew year over year, but revenue for the Class 1 railroads declined 2%. And of course, this is the entirety of the rail networks. Isn't just intermodal, it's the carloads and things like that. There is some expected increase expected because of Mexico growth.
Yeah.
That nearshoring situation should help really drive volume growth in that sector.
I think another one, it's not touched on here, but I was looking at it this morning. I mean, you're starting to see domestic oil production at or near an all-time high, and like, you only have so much pipeline capacity. The rails can kind of take hold some of that. production, that increased production. So something to pay attention to there too for growth.
Bullish on rail for the second half of the year. Parcel, however, this one kind of shocked me. Parcel market experiencing declines underscored by a 7.4% drop in domestic volumes. This is largely due to the fact that shippers are diversifying their parcel carrier base. So it doesn't mean that overall parcel demand is down.
Yeah.
There's just more competition there, which is pulling demand away from the two largest.
Yeah, I mean, you look at Amazon, what they've built out. You look at DHL's growing their footprint here domestically. You have a lot more regional carriers. I mean, I can tell you, I mean, just in here anecdotally, I mean, you just see it. I mean, you see more regional carriers than you do, somebody showing up with and then even then, I mean, they're still contracted with the big boys.
I mean,
too.
if there's money there, people will go intervene. And the last part of this, private fleet growth being a big part of this whole market environment. Now, investment in private fleets and things like that have become harder because of the interest rate.
Yeah.
So they don't necessarily know where this is going.
Yeah, I think that is the challenge. I don't know. Private fleet growth is something to pay attention to.
It's probably not going to have an influence in the last part of the year.
Yep.
So there it is. Second half outlook. You heard it here. Have a good week.